Hello, everybody, and welcome to the latest Service Department News webinar, brought to you in partnership with the Residents and Muse. Today, we are going to be looking at the M&A and investment scene in the Service Department, apart hotel, and extended stay space. My name's George Sell. I'm Editor-in-Chief for International Hospitality Media. We're the publisher of Service Department News, as well as other media brands for the real estate and hospitality industries. Our first sponsor today is The Residents, an apartment brand in London, and we are going to watch a short video to find out a bit more about them. Okay, thanks for The Residents. If you'd like to find out more about them, you can see some contact details in the chat. Our second sponsor today is Muse, Hospitality Management Software Systems, a big name in the industry. I'm sure you all know them, but again, there are some contact details in the chat. And if you'd like to get in touch with the guys at Muse and find out more, then please do. And thanks to them for sponsoring. Today's webinar will last an hour. We're going to have around 45 minutes Q&A with our panel. We'd like you to get involved and submit your questions, so you can do that using the Q&A or the chat function in Zoom. We'll either answer them there and then if they're on the topic we're discussing, or we'll save some time towards the end of the webinar to answer some of those. Everybody who has registered for the webinar will get a link to a recording of the session via email in the next few days. So a few context slides here. These are stories that we've run on Service Department News over the last few months, just to give you an idea of some of the activity in the market. Quite a bit of this relates to our panelists today, I'm glad to say. They're all putting their money where their mouths are, as it were. Staycity has just secured a lot of financing from Oak North to fund its portfolio growth. Valpre Capital has launched a new apart hotel brand and bought its first 2 sites in Athens. And Pandox last year bought the 3 Residence Inn properties in London. And lastly, Mint House acquired another operator over in the US called Locale, and we'll find out more about all those as the conversation goes on today. So we've got a fantastic and truly international panel today, and I'm going to ask the guys to introduce themselves in turn as we see them from left to right on the slide there. So first of all, I'd like to say welcome to you, Jake.
Thank you. My name is Jacob Rasin. I work for Pandox. We are a Stockholm, Sweden-based listed hotel property owner. We're active in the Nordic part of Europe, so Nordics, UK and Ireland, Benelux and DACH. We invest throughout everything from independent own operations, leases. We cooperate with about 20 brands, and our portfolio is approximately 20% operating assets and 8% leases. Apart Hotel has been interested for us since 2017, and we acquired our first Apart Hotels in 2021, and we sort of continued that pivot and that strategy last year by acquiring 3 residences in London. So thank you for allowing me to be here.
Thanks, Jacob. Good to have you here. And next, Ahmed, welcome to you.
Hi, my name is Ahmad. I'm a managing partner at Valpre Capital. We're a London-based investment firm focused predominantly on the living side of real estate. So historically, we've been active in Dublin, in London. As you mentioned, more recently, we've pivoted to Athens as well. Our focus is anything with beds in it. So historically, we've done BTR and BTS. Student accommodation is quite big for us at the moment in markets like the UK, London in particular. And then more recently, we've gone into apart hotels. So Athens is the first market we enter on the apart hotels side, and we're very excited about that. So happy to be in this panel, and thank you for having us.
Thank you very much. Andrew, to you next.
How are you doing? Andrew Fowler, Chief Development Officer for Staycity Group. Currently operating just over 6,000 keys. We have two brands, Wild, which is our lifestyle apart hotel brand, and our core brand, Staycity. Predominantly an asset light company to date, although we now have 1,000 keys and 4 London developments under our development arm, Carnsore. And we have 3,500 keys signed in our pipeline at the moment. And going forward, we expect our growth to be approximately 75-80% asset light, 20-25% asset heavy or through development.
Great stuff. Thanks, Andrew. And last but not least, Christian, welcome to you.
Thanks for having me. Good to be here. Christian Lee, CEO of Mint House. Mint House is an operator and a brand of what we call residential hospitality, but I think, or apart hotels. So we operate only in sort of high-end, premium, urban multifamily buildings. We operate anywhere from 20% of the building to 100% as residential hospitality in the US. Mostly East Coast and then Sun Belt markets. And as mentioned, we recently acquired a company called Locale, who also did the residential hospitality space. And so, looking to continue to go deeper in our markets, as well as expand selectively into new markets in the US.
Thank you, Christian. If you look at the chat, you'll be able to see links to the LinkedIn profiles of all our speakers today. So if you'd like to continue the conversation with them after the session, then please do contact them on LinkedIn. Okay, let's get stuck in, and let's start by trying to assess the general investor sentiment towards hospitality as a whole, and then specifically towards this service department, extended stay, apart hotel piece. Jacob, could I kick off with you? What's your impression of general investor sentiment towards the sector?
I think the investor sentiment is very high. Hotels have been somewhat outperforming traditional asset classes in real estate, given the strong operating fundamentals of it. I listened to JLL last week, and they said they had a record year of first-time buyers for hotels. Given we are only focused on hotels, we see that as, I guess, an increase in competition. But I think that the sentiment of this real estate class itself is very good and attracts new form of capitals. Our interest in apart hotels have sort of grown, and I think COVID really acted as an accelerator of what we believed in and what we saw, and it's mostly 3 things that makes this so interesting for us. Is that future demand versus future supply, and the second one is the high margin operations, and the third one is the sort of the consumer behavior this type of hotel product encapsulates. So, and I think this is I may steal Andrew sort of quotes here when I think I listened to you when you worked for Eden, but it's not Airbnb, it's not service departments, it's not hotels, but it's something in the middle. So we find that very interesting. So we're very interested in pursuing more acquisitions in this field. Yeah.
You said, Jacob, that you're relatively new, even though you're a sort of long-established company, you're relatively new in this space. Do you see this extended stay apart hotel segment taking up a bigger proportion of your portfolio as time goes on?
That is the plan, yes. And that is sort of because we think it's a great segment to differentiate this into, as well as we feel that in the markets we're currently in, there's great potential for this segment too. So we have the local and geographical infrastructure, and then it's easier for us to differentiate into a new segment than, for instance, going into a new jurisdiction. So that suits us well too. But we've been amazed by the rate you can achieve and the limited service nature of operations. I think that's the main two things that we're very, very impressed by, I guess.
Yeah. Thanks, Jake. Andrew, I want to come to you next. What are your impressions of kind of investor sentiment towards hospitality in general, and then specifically to this extended stay and apart hotel space?
Yeah, for sure. There's been a lot of interest over this period of fluctuation. You know, hotels are always seen as a kind of an inflation hedge, so there's been a lot of interest there. The big challenge at the moment for us is probably, you know, the long-term funds are out of the market. There's plenty of people that want to kind of get into this space. The majority of money really is opportunities money at the moment. There's very little of that longer term. The interest is there, but obviously the numbers just don't work at the moment. So I think if you're looking for investors on the opportunity side, you know, the bucket is massive at the moment. There's plenty of debt around at the right price. There's plenty of money around at the right price. It's just about aligning the numbers really at the moment. We're seeing a great number of opportunities, but they're starting to align in London and the likes, but we're seeing the price corrections coming, and I think some further price corrections need to come really in Europe until we start to see everybody align, and then we're going to see a lot more transactions. We're already seeing, you know, we've seen the Ruby Hotel stuff going on. We've seen a number of other key transactions. So the market is heating up. I think we've seen probably 50 basis points shift inward in the last 12 months. So people are coming back into the market, but it's early days, and hopefully this is the turnaround year.
Thank you, Andrew. Christian, we've had the European perspective there from Andrew and Jacob. What's your perception on the other side of the pond?
Yeah, so I think from my perspective, you have to kind of look at two different pieces, right? So for us, it's, you know, what investment is there in the multifamily world, right? How much multifamily growth is there? And, you know, that has been definitely challenging over the past 18 months. I think everyone sort of the dramatic rise in rates combined with inflation meant that everyone's projects were over budget. Everyone's, you know, rates were, you know, 200, 300, 400 basis points higher than they had originally underwrote kind of in COVID. And then you also saw a lot of, at least in the US, you know, migration from, you know, California to Nashville or New York to Dallas or whatever it happened to be. And that has somewhat slowed down. So that put a bit of pause into the multifamily world. Now that is a positive for sort of the apart hotel, the you know, residential hospitality space, because, you know, as you've seen that, the whole premise is that we can help increase NOI above what, you know, you can get from a multifamily renter, you know, on a stabilized basis. And so there's been that transition, but, you know, having fewer multifamily finishes, you know, sort of starts and finishes, is, you know, challenging for kind of overall supply in the space. That being said, I think, you know, what we're seeing, you know, especially in the last few months, is people adjusting to the new reality, right? There was a while that, you know, it was like, I don't know, survive till 25. It was sort of this theme that you'd hear at different conferences. And the reality is, like, rates aren't coming down. And I think people are, you know, sort of getting comfortable with the reality that things are going to be higher for longer than they might have otherwise expected. And so people are now sort of underwriting that and looking at that. Then on the sort of, you know, apartment, hotel, residential hospitality investment space, in the US, there was, you know, a lot of people who started in this. You've seen a pretty big shakeout. And so I think what you have left is, you know, a core group of operators who have really figured out, you know, exactly what Jacob was saying, you know, how do you sort of get that premium price with a more efficient operating model. And so I think, you know, those two things, as they start to kind of settle out, will lead to, you know, as Andrew said, more opportunity. You know, what we're seeing now is a lot more opportunity, even over the past few months and going forward.
Thanks, Christian. Ahmed, you're fairly new in the sector, and you've decided to go specifically for apart hotels rather than the general hotel market. So can you give us your impressions of what are the main strengths and weaknesses of this apart hotel model compared with broader hospitality?
So I think for us, it's coming from a different perspective. So we are coming in from more traditional real estate. So, BTR and BTS. And I think active management of real estate is the theme, and trying to extract more value. You can't, the days of buying an office lease or buying a standing asset and waiting for the coupon to come in doesn't exist anymore. And so active management makes more sense and extracting more. If you look at, how you can move into the spectrum, apart hotels, to echo some of what has been said, offer very attractive yields. If you structure them properly and if they're properly managed, the profitability is quite high, and I think that sets it apart from hotels in particular, which we're less interested in. So that's one of the main drivers for looking at apart hotels. I think the other thing is a response to the market, and if you look at today across Europe where we're active, and Athens as an example, Ireland and the UK is the same. There is a big gap, and there's a big gap of supply, and there's a big demand for something that isn't a hotel and isn't an Airbnb, and I think as Jacob said earlier, there's something in between, and we're answering that call. So you have ADRs that are attractive, you have margins which are attractive, and so it makes sense to enter that space in that way. I think the one thing I'd add generally on sentiment is that it is very positive at the moment. We're seeing more institutional money becoming more and more interested in this space, but we still need that core money to come back and be ready to take us all out, especially for us that are developing these portfolios. So I think that's still a wait and see. So any business plans that are being done, the way we're looking at them is you're going to develop these things, you're going to stabilize them, you're going to hold them for a while potentially, and you need to be comfortable with the yield on the asset, because you may not be exiting these based on your business plan.
As we've said, you're fairly new in the sector, but are you seeing the investor profile, the type of investor getting involved in this sector changing?
Yes, I think it's becoming more institutionalized now. Obviously, we're talking about in our case, we're looking at Athens, which is probably stretching that a little bit. So I think, if you were looking at this in London or in Dublin or in other parts of continental Europe, it's definitely a very well-established institutional asset class, and very comfortable with that. I think Athens is a bit more of a test, and that's why we underwrote things in a much more sober way. We're looking at a very high yield in terms of exit cap rates versus what you'd see in Western Europe.
Okay, thanks, Ahmad. And Andrew, what's your take on the investor profile in the sector? Are you seeing any notable changes?
No, I mean there's a lot of opportunities, as I said, PE. I'd say Tom Walsh, our CEO, probably gets a knock on his door once a month, looking to see if he'll sell his shares. But as Ahmed said, really the investment into the space is largely looking for taking on some operational risk, platform style, getting 2 bites of the cherry in order to get those returns, those types of PE returns. So, high return opportunities money, everybody wants to get into the space. But, we've seen Ares, LaSalle, Proprium, Brookfield, Apollo, Oaktree, Sienna, Pandox, the list goes on. There's plenty of high profile people looking to get into the space, but there's a very limited supply of product still. There's very limited number of established platforms, established operating models. So, we need more competition in the space. We need more product coming through to fuel that market. So, as I said, the money's there. It's just a case of finding them the product, if that makes sense.
Yeah. Christian has alluded to the kind of the convergence of the multifamily stroke BTR sector and this hospitality model. Obviously, build to rent in Europe is dominated by sort of long-term patient capital, your pension funds, your insurance companies, and that sort of thing. Have they made an entrance into this kind of hospitality area, or are they yet to make a play in this space? Andrew, do you want to pick that one up?
Sorry, could you repeat again?
Yeah, in the build to rent market, we're seeing a lot of sort of long-term patient capital, the pension funds, the insurance companies, and we are seeing this convergence of build to rent and apart hotel, short stay hospitality. Do you think we'll start to see those sorts of investors coming into this space as well as they are into build to rent?
Yeah, I mean, we have a lot of the long-term investors, you know, switching to the likes of Aberdeen's, Decca's, DWS, HSBC, Schroders, Unions. These are all our current landlords, and they remain interested in the space. But the forward funding market isn't there at the moment as such. There's a good market there for dry assets. You know, we've got a lot of interest from the long-term funds for up and trading assets. The challenge at the moment is we've got lots of opportunities, but we're waiting for that forward funding market to come back, or hoping it's going to come back, enabled to deliver some of those opportunities. So I think that the long-term money is there, very much established. You know, we've got a bunch of institutional landlords in that sector, and that will very much remain to be there because, you know, it's now an established subsector really of the hospitality market. But, you know, they're looking for the dry assets. You know, as I said, I mentioned the Ruby sales recently. You know, we've had a couple of approaches on a couple of our assets at good yields. You know, we're seeing yields contract, certainly 50 basis points I'm seeing from a year ago, you know, sort of low mid fives for us to sub fives now in terms of London numbers. So there is pent up demand there for sure, but there's a lack of product. And I mean lack of dry assets product. There's plenty stuck in the middle at the moment, delivering those assets. But yeah, no, the long-term demand is very much there, but just not the forward funding market.
Thanks, Andrew. Jacob, are you seeing any emerging trends in transaction activity, particularly in terms of asset valuation and deal structures?
I would say sort of emerging trends compared to pre-COVID or anything new that's coming out after coming out after COVID, and it's sort of new for structuring the deal.
Yeah, so post-COVID, is there anything, you know, in this kind of new landscape, are you seeing any trends emerging?
So for us, we saw that the great resilience in sort of apart hotel demand was actually very impressive for these types of assets during COVID as well. We're seeing an even further mix between business and leisure travel, which this product is also catering to fairly well, without the sort of the bars, the restaurants that are traditional sort of a leisure-friendly hotel, city hotel needs. So it could still be limited service, but the actual room makes it very, very attractive for instance, families traveling, people with a little bit more space, as well as the length of travel, which is we're seeing sort of a little bit of a slower travel, so you're staying a couple of more nights. On the transactional side, we acquired the Adagio in 21, which was our sort of first take on apart hotels. And when this residence in portfolio came up, it's very rare to see that type of 3 assets in city center London apart hotel. It was almost too good to be true for us, because we have not seen that type of scale of a portfolio in this very field. So I guess all hands on deck, let's go. That was sort of our feeling when this portfolio was marketed to us. But I'm not seeing a massive change in the deal structures. But what's interesting is the sort of underlying consumer behaviors for this product. And as Andrew said, the long-term demand potential of people actually staying at this type of product. That's what we're seeing most, and that's why we're so interested in this sort of segment.
How much of a driver in your decision to buy those residence inn assets was the brand behind it, the kind of Marriott machine behind it? Because I've been to a couple of those, and there's always a lot of American leisure guests milling around who I'm guessing are, you know, Bonvoy members. So would you have bought those just for the real estate, or did that play a big part in your decision too?
I think the Marriott system, this is the first Marriott hotels we do have, and we were extremely impressed by the distribution that they provide to these 3 hotels. But it sort of, the interest caught us before looking at the numbers. It was like, okay, so there's 3 in London. We've been wanting to get into London since 2015. This segment since 2017, so patiently waiting. But Mary's doing us a great job, and we also have Axiom running it. And they were currently in the properties, so they stayed on. And they also have great sort of operating expertise. And I think that's a great mix for us when we're moving into a segment like this. So we have a local operator like Axiom that works very well with a global distribution system in a market that we feel comfortable in. So it was sort of the stars were aligned for this one. So
yeah, thanks, Jacob. Christian, on the subject of deal structures, can you tell us a bit more about how your relationship with your multifamily landlords work? You obviously take a varying amount of each building. Do you simply lease those floors and those units? How does it work?
Yeah, it's a mixture today. I'd say the early days, at least in the US, of the space were all leases. And I would say a lot of it was, you know, sort of 1, 2, 5, 10 units at a time. And the transition has been to structure them more like hotel management agreements, where you take a percentage off the top, you agree on a budget for expenses, and then there's a split of NOI to you know, to owner and to the operator. And I think that, you know, that transition is happening over time. We're seeing people get more and more comfortable with that, especially as, you know, sort of traditional hotel investors are getting more into multifamily, and there's sort of a blurring of those worlds. And so people who have experience with hotel understand what a management agreement looks like. And then I think, you know, kind of going back to what Jacob said as well, is, you know, when especially owners of multifamily understand and kind of see, you know, that track record of pre-COVID, you know, during COVID, where you could kind of go longer length of stay, then, you know, as business travel has returned, especially in a hybrid world, you could have people staying for 3, 4 nights, you know, leisure travel, people staying for a night or two over a weekend. That ability to flex up and down and drive ADR and rates, you know, across a wide range of demand and a wide range of, you know, just different times of the year is attractive. And so I think that gets them more and more comfortable that kind of regardless of what the cycle looks like, there is this sort of continued demand on you know, sort of, let's call it that short and medium term. And that allows you to kind of then, you know, do more of a management agreement type models, because they understand there's a history now of being able to show the return over a variety of types of, you know, demand cycles, et cetera.
Yeah, thank you, Christian. Andrew, Staycity has obviously got one of the fastest growing portfolios in this space. Are you seeing any kind of evolution in the deal structure that you have with your landlords? Is the hybrid lease becoming a thing? Do you do management agreements, or is it still predominantly leases?
Yeah, as I said, there's a lot of demand from, you know, big investment into the sector that requires a piece of the operating pie effectively to get the types of levels of returns. So we're seeing a big demand for that. Unfortunately, it's not really a space we're in. You know, we're a lease model predominantly, although we do look at turnover amounts, hybrid leases. You know, we're certainly getting more creative in our deal structure going forward. As I said, you know, on one hand of the spectrum, we've got pure in-house development now, and on the other side, we've got a pure lease, and, you know, we'll look to do anything in between. It's about growth or sustainable growth. I think, you know, a lot of the deals we got done last year were probably because we did about 1,600 keys last year, but a lot of that was probably because we were prepared to invest some capex into the deals. A number of projects stalling out in the latter stages of their developments, you know, triggering loan to value covenants. We'll come in, put a bit of cash in at the back end to make it happen. Probably won us a couple of deals. I think that was a result of the tail end of what's being, or still is the end, hopefully the end of a challenging funding period for some developers. But do we see, I think, you know, people are going to, particularly with the funding market coming back and being probably a little bit risk averse, hopefully the demand for the lease will remain strong. We're certainly seeing that in the first quarter of this year. But like any market, you've got to stay creative, look at evolving your ways of doing things. So not to say never, but the focus remains on us for a lease business, probably 75%, and development for the latter 25%.
Yeah, thanks, Andrew. I want to stick with you for a minute and talk about geographic markets. Obviously, you've got a broad pan-European portfolio now, but which new destinations do you have in your pipeline, and where are you looking to plant a flag where you haven't so far?
For us, a big push south. So we've just taken on new acquisitions directors, Iberia, Italy. You can probably put Athens in the bucket of Italy. And then pushing east, I think Poland is a really interesting market for us. We're in exclusivity, very close to signing our first deal in Poland, 260 keys. Interesting in the sense of when you look at the sort of the growth of the hotel market, you know, the growth of the Polish economy, and we're able to peg leases to Euro CPI. You know, there's a spread, certainly excess 100 basis points to our advantage there. So that's a very interesting space. We're finding as well Poland very progressive, particularly on the development side, from a regulatory planning, a lot less red tape than maybe some of the challenges you find or the bureaucracy you find in Germany. And you know, Germany is our number 2 market in terms of growth at the moment, outside really of the UK and Ireland. But I would see us really looking at Poland as a really interesting market, based on what we've seen so far.
Yeah, thank you, Andrew. Ahmad, can I come to you and ask you why you decided to start specifically in Athens, and where else you have on your radar for future apart hotels?
Sure. Look, Athens is if you look at it from a macro perspective, Greece and Athens are, Greece is doing very well. Obviously, tourism has grown dramatically, similar to other parts of Europe, but the environment is very conducive. I think what's attractive for us about Athens is a lot of the big operators are either trying to get in there or have a very small footprint. And the opportunity really there is to create some sort of scale for them. So, when we come to look at the exit, we need to be somewhere around 200 to 300 keys. And a market like Athens, that's not easy to do if you're very well located. So the opportunity really is an aggregation play. And that's pretty much what we're doing. You're going for these old buildings which are very well located. Unfortunately, scale is not massive. And so you do need to think about aggregating a few of them together to come up with a decent sized portfolio. But if you can do that, the operators are super excited to get in. The ones that aren't in there and the ones who are in there want to expand. And then when you come to the exit, the core money, I think, will come because the market fundamentals do make sense. ADRs are attractive as well. I think if you benchmark them to the rest of Europe, they are attractive ADRs, particularly the southern parts of Europe. And then the last thing I'd say is that it's not really a seasonal market anymore. So it's not London, it's not Dublin, but it is still a pretty flat market when you look at average occupancy somewhere between 70 and 80%. That's not what it was 10, 15 years ago or 20 years ago. It used to be a stopover on the way to the islands. So the average days are longer, 2-3 days rather than maybe a day or two. And the occupancy rates are attractive. So that, that attracts us to the market, and that's why we're there. In terms of where else we'd look at, I think I'd echo the same thing. And the guys are saying in terms of Southern Europe is attractive. You know, and another area that's not to be ignored is the Middle East at the moment. So I'm in Jeddah today, and looking at what's happening here, I think the apart hotel model is also expanding here, and I think that's something that should be considered, particularly in Saudi Arabia with everything that's happening there. So maybe the Middle East, but within Europe, I think focus initially on Greece and then perhaps other parts of Southern Europe.
Thanks, Ahmed. And Jacob, you said at the start that you're very much Northern European based. Are you looking to move further south, or are you more concerned with consolidation in your existing markets?
I had two things that I really wanted to get to know a little bit more. That's why I joined this webinar. And one was like, where's the new markets people are looking at? So I was taking notes. Yes, for the time being, we like to sort of dig where we stand and look at some opportunities where we are and where we're sort of already present with, I guess, traditional hotels to say.
Yeah. Okay. Thanks, Jacob. Business travel has traditionally been one of the main drivers of service departments and apart hotels, but we are seeing a much bigger share of leisure now. Christian, how much have business travel activity levels affected your investment and growth strategies, and what part does the business traveler make up of your overall guest demographic?
Yeah, so the original incarnation, just to go back, of Mint House was the idea of catering to business, like especially young business travelers, you know, who want this. The service department model hasn't really existed in the US the same way it has in other places. Although there's much more of a build to rent model here. And so the idea was kind of putting that layer on top of it for these young professionals who, you know, certainly in the US it's very difficult for them to stay at an Airbnb or a Vrbo. Their companies don't allow them because, you know, duty of care requirements, and you know, there's always, you know, cameras on the inside of the house versus outside, not the right access control. What happens if you get in, you know, something happens, God forbid. And so the idea was provide that service layer on top of it. And then in COVID, that all went away, right? It just went to zero, obviously, overnight. And so then there was a digital nomad, right? Long stay of leisure. And I think that really opened up the market to people saying, well, I can stay at different types of places, people going to Airbnb, but realizing, well, I don't want to do chores on the way out. I don't want to have to, you know, if something happens, I'm kind of stuck. I don't know who to contact. And so this idea of putting a service layer on top of these, you know, apartments has been huge. That being said, business travel has come back very substantially for us. Now, probably 40% of our stays are business stays. And we're seeing, you know, that increases, especially at least in the US, as the sort of hybrid work model really takes hold. You know, there's certain places that are saying you have to 100% come back to the office. But many companies are saying, well, we want you in, you know, a few days a week or a few days a month. But, you know, the challenge is many people moved away from where their headquarters is. So we see a lot of, hey, I'm coming back to headquarters for 4 days at a time, and I want something place to stay that's not a hotel, right? I don't want to have to kind of get, you know, do my work from the side of my bed. I want to be able to come home. Even if I order out to eat, I have a kitchen table, or I can cook my own breakfast. So there's lots of things that come along with this, but they don't want to take the risk of going to an Airbnb or a Vrbo and having it be a bad experience. And so we are seeing a lot of that coming back. The other thing for us is we're seeing, because we take bigger portions of higher end buildings, really partnering with the, you know, building owner to monetize space in a building that hadn't otherwise been monetized. So they have a lot of times built out common areas that, you know, no one uses during the day. We've been kind of partnering with corporations to come in and take that as a meeting space, so you can actually host your meeting in that common space. We did an event where, you know, we had 10 CEOs come from a CEO forum and rented out space for, you know, a few days, and they rented out the gym from 10 to 2 p.m. and did exercises. And so it's finding ways to bring incremental revenue into the building. And a lot of that does come from those corporate type of events, those corporate travelers that really has come back, especially in a hybrid environment going forward.
Thanks, Christian. Jacob, I've read a few articles recently which have said that business travel levels have rebounded to pre-pandemic levels. Is that something you're seeing across your portfolio, and specifically with the Residence Inn, which kind of was originally conceived, I think, as a predominantly a business travel brand? Are you seeing a bounce back of the business travel in those hotels, the London Residence Inn properties?
It's slowly but surely. We're not seeing, I guess, a hockey stick movement, but we're seeing more of a grinding increase. Not very sort of, but it's so we're seeing, I guess, yeah, steadily but slowly. The one thing is the product again, and what we have is, in my mind, a great product both for business traveler and leisure traveler, because the extra space and the place to sit, as Christian mentioned, I think it relates very, very much to the needs of a business traveler as well. So I think it's a great sort of merge between business and leisure travel offerings, especially for a city center hotel. And it's psychologically, I think it's very much easier to use outside sort of order services if you have a smaller kitchen and you don't mind that there's limited food and beverage after breakfast, or for instance, our Kensington properties, we have breakfast, we have a small shop and a bar. That's about it. We don't serve lunch nor dinner, and then you can just log on Uber Eats and you get sort of the entire West London menu instead, and that I feel is much easier to do when you have those facilities. And from my personal experience, once you start living in these type of products, you kind of don't want to go back to the normal ones, because you that's my view, especially because I've always been staying there now for my business travel. So
yeah, thanks, Jacob. Christian, do you want to pick up on that one? Then I'll come to you, Andrew.
Yeah, I just wanted to echo the eating piece. That's one of the things we see from so many people. If you look at a lot of the studies now about the way people travel, something like 40% of people are actually booking restaurants before they book their, either the place to stay or their airline ticket. And so we just increasingly see there's no need to really run F&B, right? Like, again, because of all the apps, again, you can discover all of the different type of food in any city you're going to. And so again, as long as Jacob said, if you have a kitchen, a dining room, a place for them to go eat, they can order in, or quite frankly, they just want to go out and explore the city in a way that really didn't happen even pre-COVID. And so I think that's a huge driver of this model, is you don't need to have those expensive overhead of F&B and all of that stuff. And, who wants the runny eggs and the, bad, room service, like everything exists out there for you. So as long as you provide a great room and, a core location, people are more excited about that than ever before, I think.
Yeah. Thanks, Christian. Andrew, did you want to pick up on that point?
Yeah, no, I was just going to say, going back 2007, when I originally started with Staycity, it was focused 100% on the leisure market, no corporates at all. If I fast forward then to 2015, when we merged Lock with Seiko, we were backed by Oaktree, and Oaktree acquired Seiko to be the basis of the operational platform behind Lock. They were 100% corporate. So you had two complete opposite ends of the spectrum. And I would say, if you look at what is the Eden or the Lock model today, and if you look at what the Staycity model is today, they're very similar. So they both converge from complete opposite ends of the spectrum. And they fluctuate, depending on the market. If it's Edinburgh, it might be 60-40. If it's London, it might be 40-60 when you talk about leisure corporate split. It varies, but they've converged on a very similar point. And also the way travel demographics have changed. You're playing equally to both segments from a high level.
What's your personal feeling, Andrew, about the level of business travel now? Does it feel to you like it's rebounded to pre-pandemic levels?
Yeah, I think kind of not quite. Is the sentiment. We always looked at those graphs, that was going to be the end of 2027 by the time we got back to kind of full corporate travel. I don't think we're quite there yet. We're very close, but we're still probably single digit towards 10% below. But as I said, we've seen a much greater leisure demand. And I hate to use the word pleasure, but travel demographics have changed. So people are traveling, maybe less, but for longer periods of time, certainly on the corporate side. So we're getting a slightly longer length of stay, which is maybe making up for maybe that little bit of the segment that's still missing from pre-pandemic levels.
Yeah, that's what I'm hearing anecdotally, is fewer business trips, but longer ones seems to be the general trend. Sticking with you for a minute, Andrew, we can't escape talk of AI. It's transforming every facet of pretty much every industry, it seems, and our business is embracing it and trying to figure out the best ways to use it. I'm sure you guys must be too. How is technology, and specifically AI, affecting investment strategies and decisions?
Yeah, I mean, AI has been phenomenal in the customer service space, and that continues to be the area where it's applied. From a leading standpoint, we are trying to evolve it into the investment side of things. Where it's very good is interpreting a lot of high-level data. So if we're doing a competitor set analysis, or we're looking at sorry, I've got a phone in the background, 1 second. If we're looking at a number, my apologies, the standard looking at a new market might be STR sets, getting on the ground, meeting with local hoteliers. We're able to pick up and plug in an awful lot of data points now, and interpret those data points better. So I think we're able to get more accurate data in markets that we haven't been in. It's very much, sometimes you can look at all these comp sets, but there's a 5 to maybe 8 percentile that you could be out there. So I think we're certainly able to use AI to merge all these data points and get a lot more accurate on our analysis side of things. We're working on a tool at the moment that develops massing studies, so you can spit in CAD and it'll pump out our 2 brands mixes, give you something quite quick. We're still challenged on its accuracy, but I think that has potential. And the third would be then we're trying to develop a high level, like a first cut, a quick and dirty model, as we call it. So between those 3, you would have right first time data going into the model, because it's one of the biggest levers. Getting RevPAR of 6 or 7% difference could mean 15-16% on your rent offering, because it's a massive difference. So getting data right first time, and as I said, as we look to more markets and spread the wings further, just to churn through a lot of stuff at a first level, so we can less resource burn on the deals that are just not going to work, and focus in.
Yeah, thanks, Andrew. Interesting. I think it's a fascinating topic, and I think as you said, any process that involves crunching a lot of data, it's definitely going to be a massive time saver. Be interesting to see how quickly it's adopted. Let's move on and talk a bit about debt finance, development finance, and perhaps trends in the type of lender getting involved in the market. Ahmad, you've obviously got some construction projects going on. When you're looking to partner with lenders on your projects, are you looking at the kind of traditional established banks, or are there new operators coming into the arena?
It's very market specific, I think. So, in London, for example, it's predominantly the debt funds that we deal with. It's much easier, much quicker. They understand the risk, and this is short-term financing, so we're more comfortable on the construction side. I think Athens is different altogether. Athens is a bank market. So for development of the projects we're doing at the moment, those are predominantly equity and bank finance, so pretty traditional structures. So it's really very market specific.
And Andrew, the recent story, the Staycity story we ran with the latest deal with Oak North, they've been a partner of yours for a long time now. I guess they were, perhaps back at the start, they were considered a challenger bank, but they're pretty established now. But are you seeing the type of lenders involved in the sector changing?
I think it's the debt funds, as I said, it's the speed. It's LTV that you can push. As I said, Oak North, someone we've been working with for a while, both on the platform side and on the asset side. The debt piece everybody's seen in the paper really was, I would say it's more of an insurance policy. It's not something that we intend to utilize. It's more of an insurance policy for kind of downturn or sudden market shifts. And by having that there, it enables us to fully flex our balance sheet so we can run, we made 50 million EBITDA last year. It allows us to re-inject all of that 50 million into growth on the basis, or large amounts of that on the basis of if there is a seismic market shift, we don't get caught napping, so to speak. But if I look at the 4 developments that we're doing in London, it's the usual suspects really, in terms of who's going to be the most competitive, balancing loan to value versus rate, and it's traditional senior and pref, or a blend of the two, seems to be the topic, the continued topic of the moment, or actually pref lenders subordinating. So we saw the shift from obviously mezz to pref last year, and now it's very much seeing a lot of this kind of like a stretch senior product again, where the pref type lender will lend you 80% loan to cost, and then they'll deal with the subordination to the senior lender. That's quite an appealing one-stop package. You don't have all these dealing and the costs with the kind of the intercreditor agreement so much when you're layering mezz on top of pref. So there's cost savings and legal headache savings in that type of structure for sure.
Yeah, thanks, Andrew. Let's talk a bit about consolidation and acquisition of operating platforms, whether we think there's going to be an increase in that sort of activity. Christian, you've just acquired another operator. Do you want to talk to us a bit about the reasoning behind that, and whether that's a route that you're going to continue to take?
Yeah. So for us, the number one priority is always, guest experience, right? So that has to drive everything we do, and everything we invest in is how do you kind of create a great guest experience without changing the operating model, right? Still having that very light, very efficient operating model. But to do that, you really need scale, right? And especially as an operator. And so for us, what we've looked at is, are there similar, sort of folks out in the market who are doing similar things that we are, where we can kind of bring it together and leverage that efficiency of scale, and Locale was sort of a very obvious fit. And so we just feel like all the things we've been talking about, right? Investing in, that sort of, the AI chatbot guest experience, how you sort of provide a higher end guest experience in the unit, that 24/7 care, all of that. Everyone's kind of making similar investments. So, the more that you can do that on top of a larger platform, just the better it is. And so, yeah, we see there's a few players out there. I mean, M&A is always challenging to know exactly what will happen, but we certainly, we think that scale matters in this market, especially as an operator. And, we see people kind of coming to the conclusion that, consolidation needs to happen, at least certainly in the US. I can't speak as much to Europe, but, I think scale does matter from an operational perspective here. as kind of a third-party operator brand inside these properties. So we see it as something that we're thinking a lot about.
And you mentioned that the Locale deal gave you a bigger presence in some markets and also exposure in new markets too. So it was a kind of best of both worlds in that respect.
Yeah, no, it's a great point. I mean, in scale, but it has to be scale in the right places. So I think you've seen the sector, at least from an operating perspective, again, early days, a few units in a building and kind of in lots of different dots on the map. We are really focused on how do we drive deeper density in the markets that we're in, deeper density in the buildings that we're in and deeper density in the markets. And so one of the really attractive things about Locale was it was, in sort of like 5 of our biggest markets, Dallas, Fort Worth, Nashville, DC metro area, Philadelphia. It got us deeper in scale in the right places. So they're not competitive with each other. They each serve, unique submarkets. Then it got us into a couple of new markets that we had been looking at, like Phoenix. And so it was a really interesting complementary, way to build scale in the right places.
Thanks, Christian. Jacob, is acquiring operating platforms on your radar, or is it more about the pure real estate play for you?
I would say the second. And I guess our hope is that we're seeing some real estate platforms being sort of marketed, but looking at the sort of fragmentation of the operating landscape, I think it's going to continue by OpCo buying OpCo. But hopefully in some of these OpCo platforms, there may be some real estate where, OpCo doesn't want to take that, and maybe we can, tag along and buy it together with an OpCo or something like that. But our sort of strategy is real estate.
Yeah. Okay. Thanks, Jacob. Thanks, everybody. We've got to the end of our hour now. I just want to thank Ahmed, Andrew, Christian, and Jacob for their contributions. We've got a couple of slides to show before we wrap up, and we will leave the session open for a couple of minutes at the end in case you want to contact anyone in the chat or take some notes from all the information that's been posted into the chat. So our next Service Department News webinar will be hosted by my colleague Eloise. That's on March the 27th at 2 o'clock, and that is about hotel diversification, hotel brands moving into service departments and branded residences. You may have noticed that this is the 10th anniversary of the Service Department Awards. This year's awards are taking place in London on May the 13th. The link to buy your tickets is in the chat. Don't miss out. It's going to be a fantastic evening. We have got some interesting things planned to celebrate 10 years. The entry period for the awards is still open, so if you haven't got yours in yet, make sure you do. Again, I think the link to find that is in the chat. If you'd like to work with us at SAN or any of our other brands at International Hospitality Media, please get in touch with my colleague Katie, whose details you can see on the screen and also in the chat. And finally, just want to say a few thank yous. Thank you to the residents and to Muse for sponsoring today. Thanks again to our speakers for their fantastic contributions. And thanks to you all for watching. Have a great weekend. I will see some of you on the Urban Living webinars. Otherwise, Eloise will be back with the next Service Department News webinar on March the 27th. Thanks very much, everybody, and goodbye.
Hello, we are International Hospitality Media, or IHM for short. IHM is the #1 brand to engage with decision makers in hospitality and real estate. Our 4 multimedia brands lead their respective sectors with breaking news, comments, trends, and opinions across a variety of multimedia solutions. We provide an inspirational community to connect people through world-class events, webinars, podcasts, award schemes, and much more. But let us share our story of who we are and what we do. Over 10 years ago, Piers and George had a light bulb moment to provide expert opinion, comments, and low-cost digital content. And so, they went on a journey over the past decade, creating media platforms to serve the hospitality and real estate industries. We now have an engaged audience with a reach of over 60,000 monthly visitors across our website. 52,500 in our email database across all sectors, and over 68,000 across our social channels. Everything we do challenges the status quo. We believe in thinking differently. We make things simple and very easy to work with us, and we're a friendly bunch too. We offer creative solutions to help you achieve your business goals. Read, watch, listen, and meet with IHM. Connect with us for a chat today. Just look at some of the brands we have worked with recently.